Welcome to Market Brief After Hours. Today we are unpacking a major reversal in global equities. A sudden energy spike and deepening geopolitical doubts have completely shifted investor sentiment, erasing the optimism we saw just a session ago. Let's get right into the numbers and the underlying causes. What exactly triggered this sharp retreat across the major indices?
The significant jump was in crude oil prices, which reignited inflation fears almost instantly. This was driven by conflicting signals regarding negotiations with Iran. Even though there is a 10-day pause on strikes against Iran's energy facilities, extended to April 6th at Tehran's request, markets largely dismissed any signs of diplomatic progress. We saw Brent crude rise 5.66% to $108.01 per barrel, and WTI climbed 4.61% to $94.48. When energy prices shoot up like this, it reinforces the negative correlation between energy and risk assets, pressuring valuations across the board. The major catalyst for today's price action was the announcement that President Donald Trump said he would extend a pause in attacking Iran's energy facilities by 10 days to April 6th at the request of the government of the Islamic Republic.
Let's look at how that played out in the U.S. numbers. The Dow Jones Industrial Average took a notable hit today, falling 1.01%.
That is right. It dropped roughly 469 points to close at 45,960. The Dow had been coming off a recent winning session and was on track for a positive week, but investors quickly reassessed their risk exposure in light of the geopolitical news. The S&P 500 saw even broader weakness, dropping 1.74% to finish at 6,477. The losses there really accelerated heading into the close as those higher crude prices weighed heavily on valuations, highlighting just how fragile the current market backdrop is.
And the tech sector seemed to take the brunt of it, pushing the Nasdaq into correction territory.
Yes, the tech sector was hit the hardest. The Nasdaq Composite slid 2.38% to close at 21,408. Falling more than 10% from its recent high officially puts it in correction territory. Growth and technology stocks are incredibly sensitive to rising Treasury yields, which jumped significantly today. The 10-year yield rose more than 9 basis points to 4.424%. The 2-year climbed over 11 basis points to 3.994%, and the 30-year yield rose above 4.94%. Weak demand at recent Treasury auctions combined with oil-driven inflation fears created a perfect storm for rate-sensitive tech names.
Before we move overseas, there was also some labor market data released today. How did that factor into the domestic picture?
It actually showed surprising resilience. Initial jobless claims ticked up slightly to 210,000 for the week ending March 21st. That was in line with expectations and up just slightly from 205,000 previously. Interestingly, continuing claims fell to 1.82 million, which is the lowest level since May 2024. This suggests unemployed workers are finding jobs much faster. So the labor market remains a pocket of stability despite the broader macroeconomic uncertainty.
Shifting focus to the global stage, Europe and Asia also felt the pressure from this risk-off environment. How did the European indices fare?
They closed broadly lower as confidence weakened and mixed signals on peace talks created confusion. The pan-European STOXX 600 was down 1.2%. Looking at specific countries, the UK's FTSE 100 fell 1.44% to 9,961. Germany's DAX dropped 1.28% to 22,664. And France's CAC 40 declined 0.58% to 7,801. We also saw Italy's FTSE MIB lose 0.89% to 43,624. And Switzerland's SMI slipped 0.6% to 12,615.
Were there specific sectors or data points dragging Europe down further?
Miners led the sector losses, dropping 3.4%, followed closely by tech stocks, which were down 2.3%. On top of that, regional economic data was quite gloomy. Germany's Consumer Climate Index fell to -28, France's Confidence Index slipped to 89, and Italy's consumer sentiment dropped sharply to 92.6. It is a clear signal that household outlooks are weakening across the entire region.
And the Asian markets echoed this downward sentiment?
They did. Optimism around a potential de-escalation faded quickly, especially after Iran reiterated it has no intention of holding direct talks with the U.S. Japan's Nikkei 225 fell 0.27%, and the Topix declined 0.22%. South Korea's Kospi took a massive hit, dropping more than 3%, while the Kosdaq lost 1.98%. Hong Kong's Hang Seng slid 1.9%, and China's CSI 300 fell over 1%. In Australia, the ASX 200 edged 0.10% lower. The only real outlier was New Zealand's NZX 50, which managed to rise 0.37%. Governments across the region are moving into contingency mode as energy security concerns rise.
We are going to take a quick break. When we return, we will dive into the Forex markets, checking out those crucial moving averages, and we'll highlight today's biggest market movers. Stay with us. Welcome back to Market Brief After Hours. Let's pivot to the foreign exchange and commodities markets. The US dollar showed some interesting movement today. What is the technical picture looking like for the euro against the dollar?
The Euro-USD pair extended its decline today, closing at 1.1528, which is down 0.27%. Bearish momentum is definitely building here. The pair is firmly below all its major moving averages. It is trading below the 50-day simple moving average at 1.1725, the 100-day at 1.1688, and the 200-day at 1.1676. This reinforces a very clear bearish bias across all major timeframes. The sequence of lower highs and lower lows remains intact, and unless it reclaims those key resistance levels, any recovery attempts will likely face heavy selling pressure.
And we are seeing a similar downward trend for the British pound against the dollar, correct?
Exactly. The GBP-USD pair ended at 1.3331, down 0.26%. It is also maintaining a strong bearish structure, trading below its 50-day SMA at 1.3504, the 100-day at 1.3410, and the 200-day at 1.3433. The breakdown we saw earlier in the month is still defining the trend. Immediate support sits at 1.3310, and a sustained rate below that could accelerate the move toward the 1.3250 level.
On the flip side, the US dollar seems to be gaining ground against the Canadian dollar.
It is. USD CAD finished at 1.3859, an increase of 0.36%. The notable technical event here is that the pair successfully cleared a major long-term resistance zone, moving above the 200-day SMA at 1.3803. Even though Canadian wage growth ticked up to 2% year-over-year, investors were seeking safety, which drove the greenback higher. Holding above that 1.3803 level points toward an extension of this rally, with the next major resistance target seen at 1.3930.
Let's look at the precious metals. Gold and silver usually act as safe havens during geopolitical tension, but they took a steep dive today.
They certainly did. Gold closed at $4,382, down 2.74%. It has broken below the 100-day SMA at $4,600 and remains well under the 50-day SMA at $4,956. However, it is still holding above the 200-day SMA at $4,089. This signals a shift in short-term momentum to the downside after failing to sustain levels above $5,000. Silver slid even more sharply, closing at $68.09, down 4.34%. It broke below its 100-day SMA at $73.45 and remains below the 50-day at $85.24. Like gold, it is still holding above its 200-day SMA, which currently sits at $57.35, but the downside momentum is incredibly strong right now. Let's wrap up with today's individual market movers. There were some massive swings in specific equities, starting with Kodiak Sciences. Kodiak Sciences was the standout winner today. Shares skyrocketed by more than 75%. The biotechnology firm announced very positive efficacy results from a late-stage clinical trial for Zenkuda, which is their drug for treating diabetic retinopathy. It was a massive win for the company and a bright spot in an otherwise bleak market. On the other end of the spectrum, Pony AI had a rough session, despite some seemingly good financial news.
Yes, shares of the autonomous driving company tumbled 14%. They actually reported their first quarterly profit, but it came alongside an 18% decline in revenue. Investors were heavily spooked by their highly ambitious expansion plans for a robo-taxi fleet, viewing the strategy as too risky given the falling revenue numbers.
We also saw a significant drop for AppLovin.
AppLovin experienced an 11% drop in its share price. The app marketing company is being hit by reports of weakening e-commerce trends and client churn, which are expected to severely impact its first quarter performance.
There was some acquisition buzz moving the beverage sector today as well.
Brown-Forman, the spirits producer, gained more than 8% today. This rally was entirely driven by reports that French competitor Pernod Ricard is considering a potential acquisition of the company. Rumors like that always inject quick upward volatility into a stock.
Finally, Meta platforms face some heavy selling pressure due to legal issues.
Meta's stock tumbled more than 7%. The social media giant lost 2 high-profile legal cases concerning child safety on its platforms. This has immediately raised regulatory concerns among investors, prompting a swift sell-off as they reevaluate the company's legal risk profile.
It is clear that the fragility of investor sentiment is taking center stage right now. Between stalled diplomatic efforts, surging energy costs, and rising Treasury yields, we are seeing a significant reevaluation of risk across all asset classes. Looking ahead, market participants will be laser-focused on the April 6th deadline for peace talks. Any further escalations in the Middle East will likely dictate the path for inflation expectations and global equity valuations in the near term. If you find this useful, please follow Market Brief After Hours.